Welcome to Applied Financial Accounting. On this tutorial, we will be covering the complete case study on T accounts, what we did in the previous video on theoretical. Of course, it has also practical part, but here we completely look at the case study and then show you how things work on different accounts. And furthermore, we also look at the transaction relationship. For example, when the cash increases on a particular transaction, what happens with the other accounts. So before we move further, I would like you to make a pause and read this disclaimer. And this slide is about myself for people who are interested who I am doing all these tutorials. So without further ado, I'm gonna move to Excel, this Excel file. In fact, this is where we will be doing this tutorial, and I've already created a tab where all these accounts have T accounts, and just to reiterate, T accounts has a title and debit on the left side and credit on the right side, if you remember the previous slide. So always credit right side, debit left side. So let me go back to accounting equation. If you recall from the accounting equation, you remember assets, these are all assets. That means cash, accounts receivable, supplies, equipment, they are all assets accounts. And then accounts payable is liabilities, then owner's capital, owner's drawings, revenues, expenses, they are owner's equity accounts. So let's go one by one. Let's do the cash first. There are two ways to do it. You can do it manually. Well, you can also use basic skill of Excel with copying the right value in the right place. So anything that's positive, we bring it on the debit side of the cash, and anything that's negative, we bring it on the credit side. So remember, debit increases cash and credit decreases cash. So wait a minute. So we got 5,500, and then we got 5,000. Then we've got the next 5,000, which is positive. Then we've got the last $5,000. So altogether, 45,500. The sum of all this is $45,500. On the credit side, so we bring all the figures or values that are negative. So it started with $6,800, then we've got 580, then we've got 2,080, then we've got $2,800. So this gives us the sum of this minus the sum of this. It gives us $33,000. Now we move on the accounts paid receivable again, because it's an asset account. So debit increases accounts receivable, credit decreases accounts receivable. Any positive value will come on the debit side. So it started with 10,000, then 20,000. Then when it comes about credit, we've got here 5,000, then we've got another $5,000. So if you just have paid attention, this balance or this balance, they are equal to this, identical. They are the same balance. It must be the same. Then we've got supplies. Supplies is also asset account. We've got only one transaction, so we bring that one in. That's it. It has a balance of $2,200. Then we've got one transaction on equipment, $6,800. It has a balance of $6,800. That's it. Now on the liability side, so if you remember from the previous video, so debit increases liability and credit decreases. So now we copy any value that is positive on the debit side, and I'm sorry, I made a mistake. So credit, we bring it on the credit side, the positive value on the credit side. And then the negative values on the debit side. So this gives us a balance of $2,200. So just, sometimes an error happens. You want to make sure that you understand. So debit, what debit does for assets. Just remember this, it increases. So what credit does for assets, it decreases. However, what credit does for a liability, it's the opposite. So debit decreases and credit does for a liability, it increases. So you need to understand and learn this rule, and we will do a lot of more exercises. You will learn this. So just wanted to make sure you understand it. Again, owner's capital, credit increases, debit decreases. We've got $25,000, if you remember from the first transactions, that's what it is. Then we've got owner's drawing, so just pay attention. The color is the color of owner's drawings, and expenses are different because they're a little bit different. So basically when the credit decreases and debit increases, so this is something you need to understand for owner's capital. It's the same for expenses. So debit increases expenses and credit decreases. So the owner withdrew money, we gotta put it minus, for $2,800. So we've got $2,800. It has a balance of $2,800. Then revenues. So revenue normally has a credit balance. So whenever we sell, so credit increases sales regardless if it's on account or cash, and it doesn't matter. So if you remember, we had the first sales of $5,500, then we've got $10,000, then we've got $25,000. So that gives us $40,500. Then we've got expenses, and we've got 4 transactions starting with $580. Then we've got $700. Then we've got $1,200. Then we've got $180. So that gives us a total debit balance of $2,600. So now I want to start the relationship between when we have the cash increase by $25,000 on the first transaction, where is that $25,000 on any of the other accounts? So let's see here. Let's read it. Let's read the case. It says ABC invests $25,000 in cash in the new business. That means cash is increased, and then owner's capital is also increased. So I'm going to make it easy to follow, I'm going to change the color so that it's both transactions also are the same. So debit is the cash is debited. That means cash is increased by $25,000. Where is that $25,000? It's here. It's credited here. So we have not started the journal entry. Basically the way it works is that we debit cash, and by $25,000, and then we credit owner's capital by the same amount. So that's why debit must always equal the credit. That's how it works. It's just an example. And then we've got, what is the second transaction say? So transaction number 2 says an important decision was made that they purchased an equipment was $6,800. And what did they do? They bought equipment. So see here, and then how they paid it back, they paid it with cash. So we increased equipment by $6,800, and then we decreased cash. So that's how it works. So equipment is debited and cash is credited. So cash is decreased, equipment is increased, no change in the asset. Then we've got transaction number 3. We buy supplies on credit. So supplies by $2,800. So you see the supply is debited. I'm changing the color, and then it's on credit. So that means it's accounts payable. Where is accounts payable? It's here. Accounts payable. So these two accounts are, related. I can also make, using these signs, but then we're gonna have a lot of these that will be difficult to follow. So the best way would be to put them in the same color so it's easy to follow. Then we've got transaction number 4. The company makes sales for $5,500 in cash. So we go to sales with $5,500. You see that $5,500, the cash is debited by that amount, and then we should have the same amount for revenues, which is here, $5,500. Then the next transaction number 5. So the company decides to spend on advertisement for $580 on credit. That means they make an advertisement, but they want to pay it later. So that is advertisement as an expense, and then it's here, and the company is spending $580, and so because it's credit, it should be in accounts payable. So accounts payable is here. So see, the same amount. We don't have a lot of the extended colors, so just want to make sure that you understand this. Then transaction number 6, the company makes a sale for $10,000 on credit. So that means accounts receivable should be $10,000. There you go, $10,000. I'm gonna change this into this color, and then change the font color as well to white. $10,000, and that is the credit is revenues, so $10,000. So I want to make sure that it's clear. Then transaction number 7, the company makes a sales for $25,000, where $5,000 is in cash and $20,000 is on credit. So the sales is $25,000. Let's start with that one here, credit here, and then let's go back. It says $5,000 in cash and $20,000 on credit. So accounts receivable. So cash is $5,000, then accounts receivable $20,000. You see that these three accounts, they are all related. So we first basically we debit, we debit cash for $5,000, and then we also debit accounts receivable for $5,000. No, accounts receivable for $20,000. 20,000. Let me make it a little bit beautiful. And then we credit sales for $25,000. Nope. This plus this. So this should equal these two. That's why that debit account should always credit account when we do journal entry. Then we've got transaction number 8. We've got the company pays its liabilities for $850. That means we paid in cash, and then we also have owners. Wait a minute, we've got here a little problem. This is expense, not owners drawings. This is expense. Oops. So if we look at go back to the transaction, it makes cash, right? 580 is credited. Let me choose the right color, and then we've got accounts payable of 580 here. So basically the way it works is that accounts payable is 580. So I'm sorry, this is accounts payable of 580. Cash is 580. All right. So do not be confused. Do not be confused with when the company makes advertisement, and where the company makes here an advertisement on transactions on credit. That means, so what the company does is that they do advertisement for 580, and they say, I'm gonna pay this later. So that's why accounts payable. So this one correlates to this one. So I don't have a lot of colors, distinctive colors to show you. And then this was the last transaction, and then the company now pays the money back. So what it does is that it's now basically reversed the way I did it here. So they say, okay, I now reduce my account by the same amount of 580. Let me choose another color. 580. So they debit accounts payable, so that means our liabilities are reduced, and then our cash is also reduced by 580. Just want to point it out so that you do not have any confusions. So this is actually not expense, this is accounts payable, making a corrections here as well. Then on transaction number 9, the company receives payment of its accounts receivable for $5,000. So accounts receivable, so that means cash is debited for $5,000. It's a change of account. Let me put another color, this color, and then accounts receivable is credited. And then transaction number 10, if the company pays basically $700 for rent, wages for $1,200, and then utilities for $80, and it is paying it in cash. So basically all these accounts, they are paid in cash, so the expense is debited, and we paid $280. So if you sum, let's do it. Let's 700 plus this plus 180 gives us 280. So this 280 equals this. So what we do is, again, debit, let me read it here, debit rent for 700, debit salaries and wages for 1,200, and then debit utilities for 180, and then we credit cash. If I just write it, for you, we write rent, we write salaries and wages, and then we write utilities, then we write cash. We need to indent it. I'm going to show you very intuitively, and when we do journal entry, how to do that. So the sum of this equals, which is debit account, equals credit, which is cash. So that means cash is decreased, and then expenses are increased. So when expenses are increased, that means the revenue, the profit is decreased. That means the equity is decreased. All right. So transaction number 11, we receive payments of accounts receivable for another $5,000. So that means cash, again, this is the last cash, $5,000. I'm going to change this color to yellow, and then this is this. Basically, cash is debited for $5,000, and accounts receivable is debited for credited for $5,000. So there is no change in assets. We basically, the people who owed us money, they give us back, and then we, in the past it was accounts receivable, it's now converted from accounts receivable to cash account. And then transaction 12, it is the owner withdraws money for $2,800. So basically the owner's account, owner's drawing is debited by this amount here. Let me change this to this color, and then it is credited, the cash is credited by the same amount. That's how it works. I hope you have found this video helpful, and by now you have a better feeling of how this T account works. Please leave me your comments and questions. So if there are anything you don't understand, I'm happy to take the time to look at them, or if you have any feedback, feel free to leave it. And if you like it, please also like the video, and also, if you have not subscribed it, subscribe it. And if you know people who are interested, in these kind of videos, please share it. Also tell to your friends, families who might be interested. Thank you, and see you in the next video. We will be doing one more video to summarize how the accounts, debits, credits, and overall T accounts work. Thank you again.